Hello and welcome to another episode of Property Ponderings, the podcast where we dig deep into the world of property buying, selling and renovating, giving you property advice to ponder. My name is Craig Nicol, your host, and I'm a licensed real estate agent in Melbourne, Australia with over 15 years of property experience as an agency owner, property investor, renovator, town planner, salesperson, auctioneer and buyer's agent. I want you to make better property buying, selling and renovating decisions to build the future that you are chasing. Today's episode is all about what to do when your property investment isn't performing well. By the end of our chat, you'll have a clear framework to assess your underperforming property and actionable strategies to turn it around or make tough but informed decisions about its future. So let's dive in and get one step closer to your dream property portfolio. So the first thing that we need to do is define what underperformance is. A property investment is typically underperforming if 1. It's not generating sufficient rental income to cover costs or deliver acceptable cash flow. 2. The capital growth is stagnant or lagging behind comparable markets. Or 3. The overall return on investment is below your expectations or benchmarks. It's critical to differentiate between short-term fluctuations and systemic underperformance. For example, market-wide dips due to interest rate hikes or economic downturns might temporarily impact all properties, but if your property has lagged for years despite broader market growth, you're looking at a more permanent issue. Okay, so now we need to diagnose the problem. So before jumping to conclusions, we need to dig deep to identify why your property isn't delivering. There are 5 key areas that we should evaluate. Firstly, location fundamentals. Does the property location still have strong demand drivers? So look for signs like population growth, employment opportunities, infrastructure development and amenities. If major employers or industries have left the area, the location might no longer appeal to tenants or buyers. The second thing is property specific factors. Is the property itself contributing to the problem? Consider aspects like condition, layout or outdated features. Is it priced too high compared to similar rentals in the area? The third thing is management issues. Poor property management can lead to high vacancy rates or tenant churn. Review your property manager's performance. Are they proactive in addressing issues and marketing the property effectively? Fourthly, market cycles. Remember, property markets move in cycles. Is your property in a recovery phase or is it likely to remain stagnant for longer? And then the final thing to check on is your strategy. Is your cash flow strategy unrealistic? For example, chasing high growth in a cash flow negative property may strain your finances. Are you using your tax benefits like depreciation effectively? So you really need to question what your strategy is. And if you don't have a strategy, then it's very difficult to understand whether your property is doing well or not. All right, so the next part. Once we've diagnosed that issue, we need to consider strategies to address underperformance. There are 6 of these to think about. The first one, renovate or update. A strategic renovation can increase rental yields and attract quality tenants. Focus on value-adding improvements like kitchen or bathroom upgrades, painting or better landscaping. Remember, it's about return on investment, so don't overcapitalize. Secondly, reassess your pricing. If your rental income is too low, it may be priced above the local market rate. Adjusting the price slightly might reduce vacancies and increase long-term returns. Or if your rental price is too low, look at the market rate and increase where needed. The third point is to improve your property management. Switch to a proactive and experienced property manager if you're not getting results. A good manager should ensure low vacancy rates, attract quality tenants and handle maintenance efficiently. And they should take responsibility for giving you the advice to make good decisions in these areas. The fourth thing is exploring tax benefits. Maximize your tax savings through depreciation schedules, especially if your property is newer or has had renovations. Consult a tax accountant who specialises in property to ensure that you're claiming everything that you're entitled to. We did an episode a couple of months ago with Sam Geelings from Geelings Grimwood Accountants who discussed a lot of these tax benefits that you need to be taking advantage of as a property investor, or at least as a serious property investor who's trying to build a big property portfolio. The fifth thing is to wait it out. If the fundamentals are strong. Now, if your property is in a solid growth area but caught in a temporary market slump, patience may pay off. Focus on maintaining cash flow and ensuring it's rented during this tough period. And then the sixth and the tough decision is sell and reinvest. If the fundamentals are weak and you see little hope of recovery, selling might be the best option. Be strategic, reinvest in areas with proven growth, or diversify into other asset classes. If you have made a property error in your purchase, I would also advise strongly to get expert advice when you buy your next property so that you don't buy yourself another problem. Now quickly, I wanted to run through just a couple of case studies and lessons to give you an idea of the types of situations where you may feel like your property was a failure and attempting to try and turn that around. So an example, a client in Melbourne's outer suburbs faced high vacancy rates. A $15,000 investment into a modern kitchen and updating flooring allowed them to raise the rent by almost 20%, which helped them to cover the costs of the rental property within 2 years. A second case study was about knowing when to let it go. Another investor in a regional town struggled with declining rents due to closure of a local mine. Selling early allowed them to reinvest in a high-growth Melbourne suburb, recouping losses within 3 years and continuing to make some gains as we look forward now. Alright, some final tips. Firstly, seek professional advice. Engage experts like buyer's agents, financial advisors or accountants to review your portfolio. The longer you wait to do that, the more damage that you could be doing if you do have the wrong property or strategy. Secondly, monitor regularly. Track key metrics like rental yield, capital growth and market trends to spot problems early. And lastly, and most importantly, stay educated. Property investment is dynamic. Regularly updating your knowledge with industry experts is going to help you to make the right decisions on your property journey. Alright, that ends another episode of Property Ponderings. I hope today's discussion has given you a few practical tools to assess and address any underperforming properties in your portfolio. If you do want to discuss anything further from this podcast, or if you're looking for tailored buying or renovating advice, please feel free to contact me. Feel free to text or call me at 0400 122 081. Thank you. We'll talk soon. The information provided in this podcast is for general information purposes only and does not constitute financial, legal or investment advice. While every effort is made to ensure the information shared is accurate and up to date, it may not apply to your specific circumstances. Listeners are advised to seek independent professional advice tailored to their personal situation before making any property, financial or investment decisions. Nickel Buyer Advisory and Craig Nickel disclaim all liability for any decisions made based on the information discussed in this podcast. Property markets are dynamic and outcomes can vary depending on factors such as location, timing and economic conditions. Always conduct thorough research and consult with trusted professionals before taking action. By listening to this podcast, you acknowledge and accept this disclaimer.